Welcome to Finance in 5.
Since its release in early 2009, Bitcoin has grown enormously, yet remains small and volatile. Gold is doing well, but is its rally sustainable? Investing in Bitcoin or bullion can be confusing, so what do you need to know? That's the question this video asks and hopefully answers. I'm a fan of precious metals, but does that mean that I wouldn't invest in anything else? Of course not. But I'll say this, the day that I recommend Bitcoin as an asset class is the day that the Finance in 5 theme tune features saxophones and 80s synthesizers. We're going to compare Bitcoin and bullion, look at the price outlook for each, and most importantly take the mystery out of investing and make it simple and easy to get ahead. Bitcoin analysis is polarizing. There are hardcore bullish enthusiasts on the one hand, and there are those who say it's a worthless Ponzi scheme on the other. Even talking about this subject immediately puts me in the firing line of both groups. Assuming more than 3 people watch this video, which granted is a big assumption, I fully expect vitriol in the comments section from diehards on both sides, attempting to plug gaps in my knowledge one way or the other. Bitcoin briefly soared to reach $20,000 in December 2017, but then crashed down to below $3,500 a year later, and it's since bounced around in a wide trading range with little or no durable returns. Bitcoin underperformed the S&P 500, treasury notes, and a variety of other asset classes. My base case is for Bitcoin to perform well over the next 2 years, but we'll see. I like it as a small position within a diversified portfolio, without much concern for corrections using capital I'm willing to risk. Bitcoin took time to build a price history and some sense of the cycles that it goes through. I'm not a bull on Bitcoin at any price, nor someone that dismisses it outright. As an investor, these are 3 main reasons why I switched from uninterested to fairly bullish on Bitcoin early this year and remain so today. Reason 1, scarcity. Bitcoin is an open-source peer-to-peer software monetary system invented by an anonymous person or group named Satoshi Nakamoto. It can store and transmit value. It is decentralized. There's no singular authority that controls it. It uses encryption based on blockchain technology, calculated by multiple parties on the network, to verify transactions and maintain its protocol. Incentives are given to those that contribute computing power to verify transactions, in the form of newly mined coins and/or transaction fees. So by verifying and securing the blockchain, you earn coins. Bitcoin's protocol limits it to 21 million coins in total, which gives it scarcity and potentially value if there's demand. Satoshi Nakamoto himself couldn't add more coins to the Bitcoin protocol if he wanted to at this point. Bitcoin is a distributed public ledger, and owners of Bitcoin can access and transmit their Bitcoin from one digital address to another digital address, as long as they have their private key, which unlocks their encrypted address. It can be stored as a seed phrase that can be remembered and later reconstructed. You could literally commit your seed phrase to memory, destroy all devices that ever had your private key, fly overseas taking no possessions, then reconstruct your ability to access your Bitcoins with the memorized seed phrase later that day or week. Contrast that with gold and silver. Yes, they have scarcity, but you have to store or transport them and hand them over to some other person or party in order to effect a transaction. There are storage costs involved. At the same time, with blockchain, you're relying on a stable power grid. That shouldn't necessarily be a problem, and we certainly take it for granted in the West. But you're also relying on government not requisitioning Bitcoin or outlawing its use and demanding that you use only the government's own central bank digital currency. The same, though, also applies to gold and silver. As much as these asset classes are emerging as a hedge against political instability, they also require a degree of political stability to allow trade and investment to proceed relatively unhindered. Bitcoin can be thought of as a rare digital commodity with unique attributes. It's scarce, durable, portable, divisible, verifiable, storable, fungible, saleable, and recognized across borders, and therefore has properties of money. Like all money, though, it needs sustained demand or confidence to have value. Look at this chart. As of August 2020, Bitcoin's market capitalization is around $170 billion, roughly the value of a large company, and less than 10% of Apple's market cap. The total market capitalization of the entire cryptocurrency asset class is about $350 billion at this point, including Bitcoin as the dominant share. Unlike Bitcoin, gold does have non-monetary industrial use, but only about 10% of its demand is industrial. The other 90% is based on bullion and jewelry demand as a store of wealth because it looks nice, doesn't rust, and is rare and holds a lot of value in a small volume. It's divisible and lasts forever, and so on and so on. So the argument that Bitcoin isn't like gold because it can't be stored for anything other than money doesn't really hold up. Gold would have similar problems to Bitcoin if there was ever a widespread loss of interest in it as a store of value and display of wealth. Gold's advantage, though, is that it has thousands of years of international history as money, plus properties that make it suitable as money, so the risk of it losing that perception is low, making it historically an extremely reliable store of value with less upside and less downside risk, but inherently not all that different. The difference mainly is that Bitcoin is newer and with a smaller market capitalization, and with more explosive upside and downside potential, so it's more volatile. Reason 2, the halving cycle. Starting from inception in January 2009, about 50 new bitcoins were produced every 10 minutes from miners verifying a new block of transactions on the network. However, the protocol is programmed so that this total of new coins per block decreases over time once a certain number of blocks are added to the blockchain. These events are called halvings. The launch period, or first cycle, had 50 new bitcoins every 10 minutes. The first halving occurred in November 2012, and from that point on, miners only received 25 coins for solving a block. The second halving occurred in July 2016, and from there, the reward fell to 12.5 new coins per block. The third halving just occurred in May 2020. This was the beginning of the fourth cycle, and so the reward now is just 6.25 coins per new block. The number of new coins will asymptotically approach 21 million. Every 4 years or so, the rate of new coin creation gets cut in half, and in the early 2030s, over 99% of total coins will have been created. The number at the moment that has been mined is already over 18.4 million out of the 21 million that will eventually exist. Bitcoin has historically performed extremely well. During the 12 to 18 months after launch and after the first two halvings, the reduction in new supply or flow of coins in the face of constant or growing demand for coins unsurprisingly tends to push the price up. We see a pretty strong pattern. During the 12 to 24 months after launch and the subsequent halvings, money flows into the reduced flow of coins and the price goes up due to this restricted supply. Then, after a substantial price increase, momentum speculators get on board, and then other people chase it and cause a mania which eventually pops and crashes. Bitcoin enters a bear market for a while and then eventually stabilizes around an equilibrium trading range until the next halving cycle cuts new supply in half again. At that point, if reasonable demand still exists from new and current users, another bull run in price is likely as incoming money from new buyers flows into a smaller flow of new coins. Each halving cycle is less explosive than the previous one, as the size of the protocol grows in market capitalization, but each cycle still goes up dramatically. There is an analyst called Plan B whose model extrapolation is very bullish, suggesting a six-figure price level within the next 18 months in this fourth cycle, and potentially far higher in the fifth cycle. A six-figure price compared to the current $9,000 price range is well over a tenfold increase.
Congratulations.
On what? Oh.
Will that happen? I've got no idea. That's more bullish than my base case.
Yes.
But it's nonetheless a useful model to see what happened in the past. If Bitcoin reaches a six-figure price level with 19 million coins in total, that would put its market cap at just under $2 trillion, equal with Apple and the UK government's national debt, plus above the largest mega-cap companies in the world today. When something becomes successful, the law of large numbers starts to kick in. It takes a small amount of money to move the needle on a small investment, but a lot of money to move the needle on a big investment.
15 billion. Jeez.
It's easier for the network to go from $20 million to $200 million, requiring a few thousand enthusiasts in other words, than to go from $200 billion to $2 trillion simply because that requires mass retail adoption and broad institutional buy-in. The unknown variable for how well Bitcoin will follow such a model over this halving cycle is the demand side. The supply side of Bitcoin, including the future supply at any given date, is known due to how the protocol operates. This model's historical period involves a very fast-growing demand for Bitcoin on a percent gain basis, going from nearly no demand to international niche demand, with some initial institutional interest as well. I'm bullish on an increase to new all-time highs from current levels within 2 years, but not necessarily a 10 times increase within 2 years. On the other hand, we can't rule out the bullish moonshot case if demand grows sharply or if some kind of currency reset is attempted.
We get our bonuses, our investors get their profits, we get 30 cents on the dollar. It's not bad.
We're 3 times that.
Not if there's no market left to sell them in.
Forget it. We're not giving out any lifeboats.
Mark, if Morgan goes under, we end up with nothing.
Vinny. Jesus, come on. I say when we sell.
Look, I get that this is personal for you, but we have a fiduciary responsibility.
No, we don't. Nobody's acting responsible. Responsibility. Are you kidding me? We're going to wait, and we are going to wait, and we are going to wait until they feel the pain, until they start to bleed. That is what I want.
But what about our clients who've entrusted us with their savings?
I say when we sell.
This isn't about you. This isn't about you.
Hey, I say when we sell.
I hurt myself today.
Check this tweet out. I'm not trying to criticize Peter Schiff here, but the result of his poll is interesting. Just because he loves and sells gold, that doesn't make it everybody's preferred asset class. A lot of millennials favor Bitcoin. Any asset class is going to have its supporters and detractors. As long as there are more Bitcoin users mixed with less new supply of Bitcoins, that lower supply boosts its price. Demand would have to drop for it to be otherwise. Let's look at Bitcoin priced in terms of the scarce asset that we're comparing it against, grams of gold. Charles Volum's chart here, which is from pricedingold.com, suggests a more than 10 times increase in the years ahead if it bounces back to the top end of its historical range, which would imply a six-figure dollar price if gold remains static in dollar terms. But he also notes it has historically been less explosive in each cycle. He says, "My analysis starts by noticing the relative heights and timings of the highs in mid-2011, late 2013 and late 2017. The second peak is about 48 times higher than the first, while the third peak is 17 times the second, so the rate of growth in the peak seems to be slowing." Charles Volum also noticed a decline in volatility over Bitcoin's existence, again as priced in gold, but it also applies roughly in dollars. Next, notice the distance between the red and green lines for any given date. In 2011, the upper bound was about 84 times the lower bound. A year later, the ratio was 47 times. By 2015, it was 22 times, and at the start of 2020, it had fallen to 12 times. It's a good thing. It demonstrates a decline in overall volatility, peak to trough. If this pattern holds up, the ratio will be about 9 times in 2024 and about 6.5 times by the end of the decade. I don't have the answer about where its price will end up, but my base outlook is bullish, with several catalysts in its favour and no firm catalysts as to why this cycle should really be any different than the previous cycles in terms of general direction and shape, even if I wouldn't really try to guess the magnitude. Reason 3, QE. The global economy is in meltdown. We have a larger crisis on our hands than back in 2008, with larger bailouts, bigger quantitative easing, and direct cash handouts to companies and consumers paid for by central bank monetization. Look at this chart of the broad money supply in the United States and how much it's gone up just in 2020. The quantitative easing that central banks are doing contrasts with the quantitative tightening that Bitcoin just experienced with its third halving. Dollars, euro, pounds, yen, and other fiat currencies are in limitless abundance, and their supply is growing quickly, while things like gold and silver and Bitcoin are inherently scarce. And this is the one thing that bullion and Bitcoin share that fiat currency doesn't: scarcity. This is an era of near zero interest rates, even negative nominal interest rates in some cases, and vast money printing. Even a 1% spillover into Bitcoin from the tens of trillions worth of zero-yielding bonds and cash assets, if it were to occur, would be far larger than Bitcoin's entire current market capitalization. In May 2020, Paul Tudor Jones became publicly bullish and went long on Bitcoin, describing it as a hedge against money printing and inflation. He drew comparisons between Bitcoin in the 2020s and gold in the early 1970s. So how do you invest? Square's Cash app enables the purchase of Bitcoin. In the US, Robinhood, which has enjoyed an influx of millions of new users in recent years, has built-in cryptocurrency trading, making an easy transition for Robinhood users if they happen to shift bullishness from stocks to cryptos. PayPal might roll it out one day soon, and there's also eToro. My final thoughts on this are that right now I view Bitcoin as a good bet for a small part of a diverse portfolio based on its network effect and security, as well as where we are in Bitcoin's halving cycle, which favors it as a potential hedge. If a few percentage points of a portfolio are allocated to it, there is a limited risk of loss. If Bitcoin's price gets cut in half or somehow loses its value entirely over the next 2 years, and this fourth cycle fails to launch and breaks down and completely diverges from the 3 previous halving cycles, then the bet for this period will have been a dud. On the other hand, it's not out of the question for Bitcoin to triple, quadruple, or have a potential moonshot price action target from current levels by Q4 of 2022, if it plays out anything remotely like the previous 3 halving cycles did. As for gold, the bullish narrative continues to glut the internet. I've stated previously, gold and mining stocks are an essential portfolio component. However, whether or not its price will reach the highs of $25,000 per ounce, predicted by some, is open to question. This guy seems optimistic and claims to have bought $1 million of gold recently, which sounds like a lot, but is only 500 coins or fewer, or perhaps a brick or two. Despite the naysayers on my channel's comments thread, I maintain my conviction that the silver-gold ratio is relevant to guiding metal selection, and that silver has more potential to outperform gold as the ratio drops in the second half of this monetary crisis cycle that we're in, and that I am a massive fan of silver coins as an investment, although I recognize that they're less valuable and more bulky. Nevertheless, and I don't care if it makes me unpopular, I still think silver will outperform gold moving forward. Storage isn't usually a big consideration for the individual investor, as they're not buying enough for the costs of storage to be prohibitive. So all in all, whether you're choosing bullion or Bitcoin, you're making a winning choice in my estimation. It's like choosing a Ferrari or a Lamborghini, because as far as investment vehicles are concerned, bullion and Bitcoin, as things stand today, are each in the top tier or very high class. Additional note about ways to buy Bitcoin: it really comes down to your country of residence, how much you want to buy, how hands-on you want to be with it, and whether you want to accumulate it or trade it. There are trade-offs for convenience, security, and fees for various choices. Exchanges like Kraken and Binance and Coinbase are popular entry points for people buying into Bitcoin, especially if they want to trade it. Do your homework and find one that meets your criteria and operates where you live. Swan Bitcoin is good for accumulating Bitcoin. For many people, a recommended method. Ultimately, it comes down to individual needs. Generally, to minimize fees and maximize security for a big Bitcoin purchase, then it's best to maintain your own Bitcoin wallet and private keys. That's the rock solid way to go, but it does take a learning curve. If you want to just buy a bit and maintain some exposure and trade a little, some of the exchanges are a good way to get into it. So that's all for now. Thanks for watching. Let me know what your comments are. Which is better of the 2 asset classes, Bitcoin or bullion? Looking forward to reading those, and we'll see you next time. All the very best.